guys. Hello. Good day to you. Depends on when you're watching this. I'm excited because it's another fantastic opportunity for you to learn about investing and what you need to do to create wealth. And one of the things that has been fascinating, that's been happening with us at Ventura Capital, is this series we call Investing 101. So it's been a huge eye-opener for us. The Investing 101 series has helped us understand where people are in their investment journey. And the whole idea of it is to have you understand the entirety of investment before you get into it. And we've talked about risks, we've talked about gambling and what investment is not. We've talked about the mindset, which is what we started with, and we fundamentally set a tune for the rest of the series. This is part 4. It's a 5-part series, and in this fundamental, this foundation that we have built in the last 3 series, building up to this, it has helped us drive the core message of what Ventura is about. We're not about vanity, we're not about vibes, we're not about overhyped or realistic investment schemes. We are around long-term futuristic systems and structures that are going to help you create wealth. And like I said, the last time we talked, we discussed risks and we went deep dive into how Nigerians lost money to MMM, CBEX, and a couple of other MBA Forex. A lot of these investments, these things that came as investments, while they were Ponzi's and scams, and took people's money. And so today we want to talk about something fascinating, something really fascinating, and I think that is something that everybody who has an interest to invest should understand. And as the talk says, I know it sounds very direct and very a lot of people find it very insulting, but it's the truth. So are you actually ready to invest? Now, why this question is important for us is because of the present reality that we see in the Nigeria investment space, or in the Nigeria finance space. And what's that reality? We have a lot of people, creators. We've talked about them over and over again in all of this Investing 101 series, and we have a lot of these guys telling you to buy stock of 10,000, telling you to buy stock of 5,000, telling you to get your money in the NGX, Nigeria Stock Exchange. And it's fascinating. It's a nice crusade. It's a nice campaign that is going on with a lot of people trying to drive this narrative for you. It's fantastic. We don't have a problem with it, but what we have a problem with is you as an individual who needs to understand the rudiments, who needs to understand the foundation. You can literally say, okay, I throw in 10,000 today, I throw in 20,000 tomorrow. Do you even understand what investment is? That is what we're talking about. Are you actually ready to invest? And interestingly, as we go ahead with this particular webinar, we're going to introduce you to what we call at Ventura the 3 tiers of investment that you could fall into. Now, we have the foundational investors, which are young professionals who are just starting out in their career, who are basically trying to middle class earners, middle average income earners, who are trying to at least create a pathway for their future. So we call them the foundational investors. Then we have the I think we call them the middle-sized investors, which is those folks who are in business, who are top professionals, right? Sorry, excuse me. So those who are top professionals, right? And then we have the third set of people who are institutional investors. We will call them the hedge fund guys, the HNI, and sorry. And fundamentally for us, we have this categorizing so that we can help you and we can understand where you are in your journey. So today, as we're talking about, are you actually ready to invest? What we wanted to do was to make it like a lecture where we're going to just share the slide and go ahead with the talking points, but we didn't want to do that. So I wanted to first have a quick 20 minutes, I will call it unstructured conversation around why are you ready to invest, right? First, before we now go into the slide. So while we were preparing for not just now, so the last 2 weeks, we are in the last few days of 2020, June 2026, which is the first half of the year H1. We are at the last few days, I'll call it few hours. That's about 48 hours to the end of first half H1 of 2026. And one of the things we have done as players in specifically the real estate space as an investment vehicle, we are putting together what we call our predictions for H2, that's second quarter of investments in real estate, and what you should look out for and what you can do. So it's going to be out by the 2nd or 3rd of July. We're going to put out that video. We're still working on it. I mean, it's a very detailed research-based video we're putting out, and will help you understand the predictions of what to expect in the next quarter. I mean, basically they are predictions, right? I mean, but for us, it's data-driven predictions. We're going to take you through a journey of some of the things we have looked at, and from, I mean, in basically H1 of 2026, and then shooting as far back as 10 years precedence of what you as an investor can get your money involved, how you can get involved in real estate and get interesting yields. But now that's on the conversation today. Are you ready to invest? Now, in this particular webinar, we're going to do what we call the self-check. We're going to diagnose your financial readiness before risking your hard-earned capital into the market. And what that means is we're going to do because we don't want you to waste your money. We will not come and tell you, take your 5 million, your 1 million, your 100k, your 10,000 and put on the stock market, or we're not stock markets advocates, but we understand how interesting and fascinating the stock market can be. Our conversation, our investment vehicle for now is in the real estate space. So I want to state that categorically. When we get to the stock market, we're going to share a lot around it, but for now, our capital investment vehicle is in real estate. So for us, we want you to really understand how ready you are financially. And a lot of people, this is a problem I have with some of these creators. I mean, it's good to put out this investment, this content, but have you put together a structure that is going to help people understand if they are ready? I mean, you shouldn't spend your eating money you are going to use and buy food for your family. We're going to talk about it, right? You shouldn't spend your school fees. You shouldn't spend investment is not something, it's not a get rich quick scheme. I think one of the things we've explained over and over in this Investing 101 series is that it's not a get rich quick scheme. So you should not risk your capital. So remember we talked about 3 rules of investing. I said the first one is never lose your money. Never lose your money. And losing your money comes from the fact that you don't even have you're not even sure if you're financially ready for that, right? I mean, I think I saw a quote, a content where he said you can't expect to, if a medical emergency is going to have you liquidate an asset, maybe that investment vehicle was not ready for you. But then still stating all of this and going further, that's why we say we have investments for short, long, and medium term, right? So you need to understand where you are financially, and then what is the scorecard for me in my finances, and how can I take this data to guide my investing decisions, so that you don't tie your money down in an investment that that has you, I mean, you're struggling, but you have you're rich in paper, or in liquidity. I mean, remember we've talked about how investors like to be liquid. Liquidity is a huge part of it. I mean, for an investor mindset, right? They have to have liquidity. So we are very concerned about these things. And diving right into what we're going to be doing today, like I said, it is self-check, right? It's to help you understand your financial readiness before risking your hard-earned capital into the market. And the market here, I mean, like for us, we would always say capitally, primarily we're focused on real estate. So, but we touch other areas in bits, so that you also understand it in the retrospect of investing. So the foundation for us is always to I'll give you an analogy. So foundation of any building determines the height of the building. So if you're building a duplex, if you're building a bungalow, the foundation required to build a bungalow, as it were, is not the same foundation you need to build a duplex. It's also not the foundation you need to build an apartment or a terrace. And the idea is people keep asking the wrong questions. I mean, for a lot of people, young people primarily, you see them want to get into investment, and the first questions they're asking is, should I buy crypto? Which crypto is storage? Which crypto is going to go up? I mean, where are the highest returns in the stock market and all of those? So these are beginners kind of questions. You can't have you can't have a bad foundation and expect to have good results when the yield is out. So usually there's a lot of process that goes into building, right? I mean, I've given you the analogy, but you need to understand that there are lots of foundational check that needs to happen. Now, you need to also understand that most retail investors lose capital not because of bad investment, but because they invested when they were not financially prepared. So a lot of people, not like they got into bad investment. I mean, that investment vehicle was fantastic, but they had to liquidate in a very short time. So they were unable to even stand the test of time to really get the yield from that investment. So financial readiness. The first part of what we're going to be talking about is the capital foundation. Remember, we are using the analogy of a house, right? You're building a duplex, so we are using the analogy of a house. And for us, the first thing we want to specifically guide you through is the capital foundation. And what that is basically auditing your financial reality before committing funds to market volatility. So where are you? That's the question. Remember, we talked about savings and investing in our in the second part. The first part was mindset. The second one was saving versus investing, and we specified specifically, or we stated specifically, what savings was for and what what investment was for. And we said that not that savings is bad. I think in that particular webinar we went further into inflation and talked about, but then fundamentally savings is usually for short-term goals, short-term acquisitions, right? But we also said that you should factor in inflation into your savings, right? We specifically told you that while you're trying to save your resources and saving for a vacation, saving for a car, saving for emergency, saving for medicals, all of those things, you need to understand that you need to factor in inflation into that. But now that's not the conversation. The conversation here is we're talking about liquidity, right? I mean, we're going to do like a 5-part test, which we've said the part 1 is a capital test, which is now for us is liquidity check. And we've said that, do you have an emergency fund? That's the first question I am throwing to you. Do you have an emergency fund? Now, savings and investments have fundamentally different jobs, right? I have to specify, so you go back and watch. I mean, that video is going to be somewhere on the screen, so you can just go back and watch that investment video and the savings and investment video, so you understand what savings is and what investment is. So savings projects your current wealth, right? And investment grows your future wealth. I I mean, when you say you've saved, I mean, you're saving, and it basically projects how much you have. It is a reality you're currently in. While investment predicts or is a futuristic wealth definition. Now, if every unexpected crisis forces you to liquidate your market portfolio, you break the circle of growth, right? We've talked about how that it is long term, it is required to mature in the market. So that's sort of why I have, I mean, people who are saying that buy the stock market, and make it seem like it's an investment. I mean, what they're basically doing is they're trading. But the guys who create content will tell you that it's investment. I mean, remember we talked about the difference between savings, investing, gambling, and trading. That was in the last webinar. We talked about trading, we talked about investing, and we talked about gambling. We're talking about risk factors, so you understand. Trading is usually short term. You're buying against the market and hoping that the market appreciates. I mean, not just hoping, right? You're using data to guide, to inform you into a certainty of a yield, right? Some of the institutional investment companies or investors do not, when they do the trading thing, they do it very strategically. Now they're attentive to everything. So somebody made a joke the other day, or yesterday actually, on Instagram, and they said, once the market closes on a Friday, I mean, why that joke? I'll give you context to the joke. So Trump had signed a peace agreement with Iran last week. I think it was on the Thursday or Wednesday, I'm not sure right now. And the stock markets felt a bit of a move, right? I mean, oil price, Trump insisted that oil needs to reduce. I mean, there were lots of ship movements in the straits of Hamas. And what now happened was, on Saturday, Trump blew up Iran nuclear sites. So when I saw the news, it was so funny. Somebody now said that Trump waits for the stock market to close, and then he makes this move, and then maybe on Monday he's now going to tell us that, oh, Iran has made a good deal with us. sorry, but the idea is, I mean, that's bomb he did must have certainly affected the US market. I mean, and the funny thing is, it now spans across almost every other global market because of that. I mean, you signed a deal, a peace deal, so why go back to blow them up? So I just wanted to give that example so you understand what trading is. So if the guys who are telling you trade, invest 10,000 and in the next 6 months, I mean, it's nice. You can actually do that and then pull your funds out. No offense to them, but it's traded. It's not exactly an investment, right? I mean, yes, you could say it's an investment, but typically it's trading, right? Because you're hoping that the market favors you in the short term, right? Now, for an analogy, right? If you plant a mango tree and then you constantly go to, typically a mango will take, I think, 4 to 5 years, the more, the less. Now, if you plant a mango tree and then you constantly go to cut the stems, as it's growing, fruits haven't sprouted out. You start going to cut the stems. Every time you're taking out a branch, it would never mature, right? Because you're obstructing the growth. You're affecting the growth circle. Understand this analogy I'm giving now, but compounding requires absolute timeline continuity. Emergencies disrupt time, right? Compounding is saying, so we have, for example, if you're investing in real estate and you say your plan is to buy a piece of property or buy a period, I mean, what we usually would do is tell you, I mean, don't come and buy, not like you can buy, but then we always advise that, are you willing to hold this for 5 years minimum? I mean, so that you can have more, you can have a better results than just doing, oh, I buy today, I bought a land of 5 million today, and tomorrow I have a family need, and then the real estate companies are now pressured to sell the land for you, because sometimes you try to do it but you're unable to. I think some of the data I can throw in here is, we looked at the average sales time for developed properties and real estate in Port Harcourt in the data, in the outlook we're going to be doing for the second Q2, and we figured that it took averagely 55 days to sell a property. So if you have an emergency, would you wait 55 days typically, based on this data that we have gathered? So the first question we have just said, which is the liquidity check, do you have an emergency fund? The next question is debt already spending your future? Now what that means is the cost of high interest debt, right? Debt is borrowing tomorrow's income to finance today's impulses. Now trying to invest while carrying predatory lifestyle debt is like pouring clean water into a severely leaking bucket, right? I mean, you're trying to invest, but your lifestyle is not okay. So the most typical example I can give you is those people who take cars on mortgages, or houses on mortgages and cars on loan in their offices. I mean, you have to pay it over a period. I've seen cases where you're not able to pay through the 5 years or 6 years period, and then you're probably laid off, and after the layoff you have to give back the car, right? Because you are not able to follow through. Now, guaranteed incomes, now paying off a 25% loan, interest loan, is financially superior to chasing risky 18% market yield. Lifestyle, now buying consumer tech on credit immediately reduces future investing capacity. So you've seen people who, I mean, one of the examples is the company Easy Buy. Yes, Easy Buy, and then there is there's these guys that are popular online. I remember their name. So, but the first thing is the cost of high interest debt, right? And the second thing is productive versus consumptive debt. Now, productive is, not all liabilities are created equally, right? Wealthy individuals rigorously audit the purpose of their leverage before taking risks. Now, the first one is dangerous liabilities. So we have consumer finance, lifestyle loans that reduce monthly cash flow, right? So let's say you earn 5 million or you earn 2 million, and then you have to you now take a loan or take a mortgage, a facility for something. You take a loan for a trip. Mostly, let's say you take a loan for a pleasure trip because, oh, you can. You're pressured by friends saying, oh, let's go to the Maldives, let's go to Paris, France, let's go to the US for the World Cup, and then I ain't good, so you take a loan that spreads across, let's say, 4 months, 5 months, and then this is like a dangerous liability, right? That's what we're saying. We're trying to explain productive and consumptive debt, right? Now, so what is the acceptable leverage? So if you are taking that loan to invest in a business expansion, productive activity, any power education. So if you're taking the debt to finance yourself in like an education, you know that this has a high yield. Remember, we've talked about the fact that fundamentally your first investment should be yourself. So if you're taking a loan against an investment for you, it's productive. You're taking a loan for business expansion, it's great. You're taking a loan for productive equipment. Maybe you're trying to drive a particular thing that will yield results positively and put you in a positive credit side, you can take the loan, right? You can take debt, you can use that as a leverage. So remember, we've talked about the first thing is, what is your liquidity audit? Do you have funds, and you have emergency funds? Before you start investing, you need to understand this. The next one is the liability. That's what I just explained. A liability audit, which is a debt. Are you using debt to fund your future? Now, what is the next one is capital source. Are you investing with true surplus? Now, what that means is investment money must never be survival money. Understand it very loud. Okay, investment money must never be survival money. And if losing the capital means you cannot comfortably pay your next month's rent or buy groceries, or you're not ready to invest, you're gambling out of financial desperation. So when I saw the movie Industry, I think I talked about it briefly in the last webinar when we were talking risks, and I said a fantastic trader got into a mess, a debt, right? And while he did that, he used some money to now invest in the market, and then the market went good. He took that money, instead of him to solve the problem that he had at home, that is the debt, the problem, he took that money and went ahead to gamble it again. Gamble, that's, he invested money. You've gotten a yield. So he had a debt of about $25,000, and then he got a yield of almost $40,000. And then I think one of his bosses gave him a bonus of $5,000. So he had $45,000. He could have paid off the debts he had, which eventually became a terrible thing for him. So that debt led to the death of his wife. The creditor came and took his wife's life, because he was upset that the guy had delayed his payment. Now, that's extreme cases. It's a movie, right? The name is Industries on HBO, home box office. So if you're investing and you're not sure of your next income, you're not clear on the next finances, you shouldn't risk that, right? Do not take survival money to invest. Now, when survival funds are tied to live markets or tied to an investment scheme, panic sets in, right? You will become erratic. The guy will use the survival money to go and invest again in the stock market in that movie, and everything was literally a mess. I could look for a clip and play. Maybe eventually when I show the slides, I'm going to show you a short clip about that movie. And you now have panic or terrible. You make terrible decisions. So calm, secure mind constantly make superior financial decision. I saw a reel today, and it talked about, it was a short video of a guy talking about how that you shouldn't take certain projects up because you're desperate. Now let's go. So remember, we're still talking about, are you ready to invest? And we've said there are several steps or tests you need to go through. The first one we stated is your liquidity test, right? The next one is your debt test. By liquidity test, say how much you have emergency funds. Then debt, we talked about, are you borrowing against an interest that is higher than, or are you borrowing to invest in something, a business, real estate, and you're not sure of the returns? It's better to borrow to invest in something than to borrow to fund your life, right? Then that's if you understand where you are in that borrowing quotient. Now the third one is the capital source. Where is your money? Is it surplus? Do you have surplus money? You earn enough to be able to set aside some amount to invest. And then the third one, which is psychological baselines now, is temperament, patience, and circle of competence. So we have 4 and 5 is your mindset check. You need to understand. Remember, we're talking about, are you ready to invest? Are you mentally ready to invest? And for this, it is basically two things. We call it first the patience horizon, and then we have the circle of competence. So I would explain them in short details as we go further. So can you leave it alone, which is a patience horizon? Growth requires patience. Growth rewards patience too. If liquidity requirement is less than 24 months, aggressive asset allocation is highly dangerous, right? So if you are investing massively, and like I said, do not buy land with your quotes survival funds. Now, short-term limits. So keep capital needed soon in high liquid stable investments. Do not put an investment. I already gave an example when I spoke about how long would it take you to. I think one of the questions we would ask, we're putting out a series. Yeah, I forgot to mention. So we are publishing an exclusive section we had with almost 100 private investors in the real estate space, and it's a 10-part series on land acquisition, right? So that's going to go live next week, and I'm really pumped about it because it has so much information and so much knowledge around investing in lands. So I was talking about your patient horizon, which is the next test. How patient can you be? The next one is the circle of competence. Do you understand assets? Right? We talked about this when we're saying the rules of investment, right? The second rule of investment is do not invest in what you don't understand. Do not invest in what you don't understand. So never outsource your independent critical thinking to the influencers or hearsay. And that's one of the things we've seen. An influencer just tells you, oh, I bought a stock of 10,000 and it grew to, okay. Do your own research. Have your own knowledge. These things, the interesting thing is we live in a society where knowledge is almost so easy to get. It won't take you any. I told you, I think I mentioned in one of the webinars where I said I was invited to a small circle of investors meeting, and then they started talking about the investment, and it sounded so realistic and fascinating. Then I took my phone and said, okay, let me Google these guys. And I Googled them, and in Nigeria, and I saw the first thing, I think down the Google first page or its second page, I saw that the Security Exchange Commission had put out a notice that investment scheme that these guys were selling was not licensed, and you'd be liable for any loss you would experience engaging in them. So it was already a unique thing for me, right? Knowledge. So Warren Buffett's rule says operate strictly within your circle of competence to drastically lower systematic risks. So one of the things we've seen with Warren Buffett is how consistent he has been in the stock market and in the wealth scheme over the period of time. And he has stayed consistent. He will always say he will invest in something he does not understand. Circle of competence. Stay within your circle of competence. You must know what drives return and what triggers a total loss. Remember, we talked about this in the previous webinar in knowledge. You need to understand what is the risk factors available so that you're not hyped up by what an influencer says and then you later go and drive the influencer and say, oh, you told me to invest. Why didn't you spend the time to get your own information? Don't be swayed. Don't be influenced by an influencer or hearsay. Right? This is like the fourth and the fifth tests. Now this fifth and the sixth test is emotional and volatile emotions and goal allocation. So the markets rewards mathematical discipline but brutally punishes emotional reaction. Fear, greed, and FOMO are the greatest direct destroyer of retail wealth across history. So, panic buy, panic sell. That's the example of emotional, how volatile are your emotions. Remember, we're talking about, are you ready to invest? And we've been talking about the test you need to take and to know where you fall in if you're actually ready. So, do not be swayed. Okay, so I'm going to give you an example of a very perfect emotional stability for investment. So if you watch the movie called Billions Billions is a fascinating movie where um, it's an investor who bets against the US markets when the what's it called now, 9/11 occurred. So 9/11 is when the World Trade Center America was attacked and a plane flew through the World Trade Center. So it crashed the stock market and he bet against it. He bought and sold a lot immediately after the stock market recovered and he made so much money. So now some of his colleagues, a lot of his colleagues actually died in that event because they were in the building when it happened. He was out coincidentally, and so his colleagues' wives were constantly. I mean, he was a very nice guy. He went ahead and took the responsibility of taking care of his colleagues' families, but a few of them were still very emotionally biased about the whole fact that why was he the only one who survived it, right? And even the FCC, all of the organizations or the agencies that regulate businesses in America were after him. I mean, most of them were because what was the trigger? But he was an emotionally stable person. So there are certain news that happen because of. You need to understand now. It does not mean you should stay on the risky. You need to look at precedents. What happens? I mean, how does the stock market react? I just give you an example. When Trump said there's a peace agreement, it affected the stock market. Now he went ahead and blew up a nuclear site after he had said that. That again would have affected the stock market. So how emotional are you to understand these things and stay, right? The next one is goal allocation, right? Which is like the 7th step. And for us, goal allocation takes me back to one of what I have said in one of our webinars where what is success mean to you? What is financial freedom mean to you? Financial freedom could mean that you have enough liquidity in a 15 years period that can fund your lifestyle, that can fund your children's lifestyle, that can, I want to have a trust for my 4 kids. I don't have 4 kids, I'm giving you an example. Or my 2 kids, I want to have a trust for them. Each of these children should have at least 150 million in a trust. That could be a financial milestone, right? A financial goal. It's also a check. I mean, you don't have to do that, but you can do short term. So in 5 years, what do I want to do? What would my financial milestone be like? So that I can apply that into my planning to know where I'm going to around and how I can invest. So capital without direction is rapidly wasted, right? I mean, it's more like saying that you're driving north without a specific place you're going to. You keep going north and north and north and north without a direction, right? Every single naira you invest should be assigned to a specific thing. Is this for retirement? Is this for business expansion? Is this for my kids' fund trust? Is this for business expansion? And every other thing, you need to understand where you are in what your goal is specifically around your investments. So there is a scorecard, right, for this. The first one is 0 to 2 points foundation. What does this mean? If you fell between the 1 and 2 points, which were our first and second points we had stated was how liquid are you? We've talked about liquidity, and then we went further to say how much debt are you in, right? Liability check, and we said that. So if you fell between that 1 and 2, you're considered to be in the foundational stage of investment, which is you're preparing to invest too early, right? Stop watching market charts and redirect 100% of your energy into building your liquid savings base, right? If you're in that category of 1 and 2, you need to reduce your eyes on the market or real estate, or stop looking at. I mean, you can motivate yourself with expensive real estate, 150 million and 200 million houses, right? But do not do that. Focus on trying to build your liquidity. So do you need to earn more? Do you need to build more skills that can earn you more money? Next one is the 3 to 5. Now, 3 to 5 points is you have laid foundation but carry significant vulnerabilities. Eliminating remaining high risk consumer debt before scaling your assets. Then 6 to 7 is market ready. So we say foundation first, steady progress, and then market ready. You have developed the discipline, baseline habits of an elite investor, focused strictly on system consistently over decades. So you have now understood the game and you are trying to play by the game. So the core principle of wealth creation is the greatest investment you will make isn't into the stock market, is in real estate, crypto, or business, is becoming the kind of person who is constantly building, protecting, and growing wealth. So understand this unique principle of wealth, right? The greatest investment you will make isn't into the stock market, real estate, cryptocurrencies, or business. It's into becoming the kind of person who can constantly build, protect, and grow wealth. So if that is you, speak to us today. So we will help you do an audit, a detailed audit for your finances. You can send us a message on our Instagram. You can see the Instagram handles going on your screen there, Ventura Capital, and then we will send you a dossier, and then we can do your audit for you to know where you are and if you're ready to start investing. So without further ado, I'm just going to dive right into showing you a slide. It's just going to be a read through. I hope you follow me as fast as possible. So are you ready to invest? Investor self-check, diagnose your finances, financial readiness before taking risks. So we've said the foundation always detects the height, and most beginners start by asking the wrong question: what should I buy? Which crypto should I surge? Which crypto will surge? What are the highest returns? Imagine building a 5-story architectural masterpiece on swampland. Even with the finest engineers and premium materials, the building still collapses. Now, a bad foundation, the failure wasn't the building design, it was a weak soil underneath. Preemptive losses. Most retail investors lose capital not because of bad investment, but because they invest before they are financially ready. Now the next point is the first test, which is the capital foundation. So there are three. We made it 2 parts or 3 parts in the investor readiness. The capital foundation, auditing your financial reality before committing funds to the market volatility. The first one is the emergency fund. Savings and investing have fundamentally different jobs. Savings protect your current wealth. Investment grows your future wealth. If you every unexpected crisis, medical, business slowdowns, repairs, forces you to liquidate your market portfolio, you break the circle of growth. Now, mango tree analogy. Now, the consistent emergency withdrawal are like pruning branches of a young sprout. It will never mature. Now, uninterrupted time compounding requires absolute timeline continuity. Emergencies disrupt time. So we go to the next one is debt already spending your future. So we said the cost of, I'm going to just go fast. I don't want us to hit the 15 minutes mark so that we can finish. So we have the productive. We've talked about this in the webinar. This is just a run through of the slide. Now, one thing I want to also state is most of all of these slides that we produce are going to be available at the end of the Investing 101 series, and you can download them and read and study for your own personal help. So investing money should or must never be survival money. We've stated that already. Now the next point is the psychological baseline, and we have the patience horizon and the circle of competence. Now the circle of competence is a Warren Buffett's principle or rule of investing, right? The first one is patience quotient, horizon. I want to call it quotient, right? It's like emotional quotient, right? how long or how can you leave, how long can you keep or leave the investments alone, right? Then the next one is, do you understand the asset you're trying to invest in? So we go to the next one, which is volatile emotions and goal allocation. Understand the goal you're trying to chase with your finances before you invest, and then emotional volatility. So we have the readiness score for you to understand where you are and what you should do. Then the last thing is the core principle of wealth creation. So the greatest investment you will ever make isn't into the stock market, real estate, cryptocurrencies, or a business. It's into becoming the kind of person who can constantly build, protect, and grow wealth. And for the last part, we would like to start your audit with you. And by so doing, we would want you to send us a message with the social handles that is moving on your screen right now. Just send us a message and we would send you an investment questionnaire to guide you through where you are and what you can start doing. Thank you guys so much for joining us in this part 4 of the Investing 101 series. It's been fascinating, it's been unique and amazing, and I'm so pumped, I'm so excited because we have meticulously followed through this series. And for everyone who has been joining this live webinars, we appreciate you, we thank you, and we want you to know that Ventura is here to help you achieve the highest level of wealth possible through structured and defined data-driven investment opportunities. I remain my humble self, Paul, Confidence Managing Partner at Ventura. See you in the next one.